Welcome to the Finance Abridged Digest for the week ending Friday, April 24th, 2026.
It is quite a week to unpack, honestly.
Yeah, to say the least. So look, there's a silent automated mechanism currently breaking the world's most popular investment strategy, index funds, meaning millions of everyday investors are blindly buying at the absolute top without realizing the underlying structure of the market has completely shifted. Right. We'll get to exactly how this passive buying is distorting prices and what immediate actions you need to take to protect your retirement.
It's vital we get into that today.
Quick reminder, nothing in this show is financial advice. We don't know your situation, your goals, or your risk tolerance. We're here to break down what the experts are saying so you can make your own informed decisions.
Exactly.
Okay, so we have a massive agenda for this deep dive, which means we are unpacking what analysts across the board are calling the Great Restructuring.
Right, the big macro shift.
Yeah, we're looking at like 35 different technical perspectives here. Everything from global liquidity to this booming trend of industrial reshoring, the terminal phase of the 40-year bond bull market, and of course, the absolute historical whiplash we just witnessed in the gold market.
Which was just wild to watch.
Truly. So if you are a serious self-directed investor, managing your own portfolio, you need to understand that the fundamental physics of the market, the stuff that worked perfectly from 2010 to 2020, those rules are just completely breaking down.
What's fascinating here is that we are not looking at standard cyclical fluctuations. Like, this isn't a temporary dip in housing starts or, a single bad earnings quarter for the tech sector.
Right.
The structural rules of the last 4 decades are breaking in real time. We are aggressively transitioning out of a hyper-financialized economy.
An era where paper assets and zero interest rates just ruled everything.
Exactly. We're moving forcefully into a physical, resource-constrained economy. And this deep dive is entirely about translating those massive tectonic shifts from the institutional level down to actionable portfolio decisions for you, the serious retail investor.
Let's start right there, actually, because to understand why your portfolio might feel, completely out of sync with the daily headlines right now, you have to grasp this macro regime change.
You really do.
Ed D'Agostino's thesis in the brief argues that this great restructuring has officially begun. He makes it clear that this isn't some abstract prediction for 2030, right? It is happening right now, in the present tense.
Yeah, D'Agostino points to 3 unstoppable interwoven trends driving this whole restructuring. We are looking at artificial intelligence, global tariffs, and the fundamental economic decoupling from China.
Wow.
Think about the mechanics of the U.S. economy for the last 30 years. It was built entirely on outsourcing manufacturing to cheaper overseas labor markets and essentially importing disinflation.
Right. We exported our capital expenditures, our capex.
Exactly. But now, due to geopolitical friction, severe supply chain vulnerabilities that were exposed over the last few years, and these aggressive new tariff structures, all of that physical production infrastructure has to be rebuilt domestically.
Which is incredibly expensive.
The sheer amount of capital required to build just-in-case domestic supply chains rather than just-in-time global ones is staggering.
Okay, but I have to play devil's advocate here.
Sure, go for it.
If this great restructuring and physical reshoring is happening right now, why are tech stocks still dominating the tape while manufacturing data in the recent PMI reports still looks somewhat sluggish? I mean, D'Agostino says we are in a physical economy, but the market screen still looks exactly like a digital financialized one.
Well, the market screen is looking in the rearview mirror, heavily distorted by the passive index flows we are going to dissect in a moment.
All right.
But if you look under the surface at actual corporate spending, the shift is undeniable. Companies aren't just talking about bringing supply chains home. They are pouring hundreds of billions into physical land, concrete, and steel. Wow. And that connects directly to the analysis from Michael Howell, which frankly flips the entire traditional financial playbook upside down.
How so?
Howell argues that the markets are completely misreading what he calls a late cycle liquidity crunch. And largely it's because they are entirely focused on the wrong institution.
You're talking about the Federal Reserve.
Yes. Howell's primary argument is that the Federal Reserve is becoming irrelevant to the real economy.
Irrelevant.
He states that domestic capex and global demographics are now sitting in the driver's seat, completely superseding monetary policy.
Okay, let's unpack this. Because if the Fed is irrelevant, doesn't that render the last 15 years of investing strategy totally obsolete?
I mean, yes, pretty much.
Like for a decade and a half, every single retail and institutional investor has been trained to hang on every syllable out of the Fed chair's mouth. The equation was just so simple. Rate cuts mean stocks go up, rate hikes mean stocks go down.
That was the entire game.
It's like we've spent 15 years obsessing over the thermostat in the living room, completely ignoring that someone just ripped the roof off the house.
That's a great way to put it.
The Fed can play with the dial all they want, but if Howell is right, the weather outside is what's actually dictating the temperature now.
Yeah.
So how is a self-directed investor supposed to adjust if Fed rate decisions no longer dictate market direction?
Well, let's look at the actual mechanism of why the Fed mattered so much before versus why it's losing traction now. When the economy is entirely driven by financial engineering, the overnight interest rate matters immensely.
Right.
Borrowing costs dictate how cheaply a massive corporation can issue debt to buy back its own stock, or, how easily venture capitalists can fund unprofitable software startups.
Well,
in that environment, a 25 basis point hike from the Fed chokes off the lifeblood of the market.
Right, because it's all just paper leverage.
Exactly. But contrast that with today's reality. We have massive demographic-driven labor shortages as older generations exit the workforce. At the same time, we are mandated by both government policy and basic corporate survival to build physical factories, semiconductor fabrication plants, and localized energy grids on U.S. soil.
So the spending is essentially non-negotiable.
It is forced physical spending. Imagine a semiconductor company building a $40 billion fabrication plant in Arizona or Ohio because of national security mandates and supply chain security. That company is not going to suddenly halt construction and leave a half-built concrete shell rusting in the desert just because the Federal Reserve raised the overnight lending rate by 0.25%.
Right, they can't just pause that.
No, the CapEx must happen regardless of the cost of capital. Howell is telling us that this forced demographic and infrastructure-driven spending is propelling the real economy forward, entirely independent of the Fed's monetary tinkering.
Wait. If this domestic capex boom is happening, where's the pain coming from? Because looking at the brief, we have two highly respected analysts looking at the exact same macroeconomic data and arriving at completely contradictory, terrifying conclusions.
Yeah, there is a major split in the analysis.
You have Chance Finnecane screaming from the rooftops about global stagflation, and then you have Craig Fuller pointing to a miraculous U.S. industrial boom. How do we reconcile that for the listener who is trying to figure out if we are entering a golden age of manufacturing or a 1970s-style stagflationary nightmare?
It comes down to understanding that two seemingly contradictory mechanisms can operate simultaneously in different spheres. Let's break down Finnecane's position first.
Okay.
He is waving a massive red flag regarding global stagflation, and he traces the causality directly to a global oil price shock.
Right.
The mechanics here are historical and brutal. When the baseline cost of energy skyrockets, every single physical input becomes more expensive. Transportation, manufacturing, packaging it, all costs more.
So consumer-facing businesses are forced to raise prices.
Right, but consumers, who are already squeezed by inflation, just stop buying. Revenue falls, costs rise, and traditional corporate profit margins are absolutely crushed.
So Finnecane's advice for the retail investor is to pivot immediately out of those traditional consumer discretionary stocks and into commodity-exposed businesses like crude oil, natural gas, and gold, simply to survive the input cost squeeze.
Correct. But then we look at Craig Fuller's data. Fuller is tracking the physical movement of goods, freight markets, trucking logistics, the construction of manufacturing facilities.
The physical stuff?
Yeah, and he points out a miracle turnaround where the U.S. industrial economy is actually booming, appearing to completely defy the drag of those exact same high oil prices Finnecane is worried about.
I see the disconnect. Finnecane is looking at the global, macro-level stagflationary markers, while Fuller is looking hyper-locally at the physical effects of U.S. reshoring. Fuller is basically saying that the sheer brute force of bringing supply chains back to North America is creating such an isolated, massive boom in domestic capex that it's temporarily overpowering the heavy gravity of high global oil prices.
That is the exact mechanical resolution right there. It is a localized physical boom masked by a global stagflationary environment. If you are managing your own portfolio, you cannot afford to pick one thesis and stubbornly ignore the other.
So what's the actionable takeaway here?
The actionable takeaway is dual-pronged. First, you must aggressively watch those domestic industrial capex and reshoring sectors, the companies pouring the concrete, building the electrical infrastructure, and providing the raw materials for the new physical economy.
Got it.
But simultaneously, you must hedge your portfolio against the broader global drag of stagflation by holding commodities. The era of blindly trading off the expectations of the next FOMC meeting is over.
Because the Federal Reserve cannot print a physical semiconductor factory.
Right. And they certainly cannot print a barrel of crude oil.
Which brings us to a massive structural vulnerability sitting in almost every listener's retirement account right now.
This is the big one.
Yeah, if the macro regime has decisively shifted away from financial engineering toward physical capex, the passive investing strategies that absolutely dominated the last decade are no longer just outdated. They're a structural trap.
They really are.
We need to dissect Jonathan Welham's stark warning in the brief. He states unequivocally that index funds are broken and active stock picking is mandatory.
This is perhaps the most dangerous mechanical illusion in modern finance. Let's look at the underlying math of why Wellham is sounding the alarm. Right now, 50 to 60% of all market flows, all the money constantly pouring into the stock market, are going blindly into passive index funds and ETFs.
Wow, 60%.
Yeah, and to understand why that is a systemic danger, you have to understand how a vehicle like the S&P 500 actually functions. It is market cap weighted.
Let me stop you there, because we need to visualize the sheer scale of that weighting. Market cap weighted means the larger a company's total valuation gets, the larger its percentage becomes within the index.
Right.
Currently, just 10 individual stocks make up roughly 30% of the entire S&P 500 index. The other 490 companies are fighting over the remaining crumbs.
And that structure creates a terrifying self-fulfilling feedback loop of price-agnostic buying. Walk through the mechanics of a standard biweekly 401k contribution.
Okay.
An investor gets paid, and $500 is automatically deducted and sent to their brokerage to buy an S&P 500 index fund. The automated algorithm executing that buy order does not perform fundamental analysis.
Right, it doesn't care.
It does not look at a company's free cash flow. It does not care if a tech megacap is massively overvalued, trading at an absurd 80 times price-to-earnings ratio.
Here's where it gets really interesting, though. Because that algorithm is structurally forbidden from analyzing value, it just blindly shoves 30% of that investor's paycheck into those top 10 largest stocks.
Exactly.
Which pushes their prices even higher, which makes their market cap even larger, which means the next biweekly paycheck will buy an even higher percentage of them. Are millions of retail investors essentially acting as blind momentum traders without realizing it?
They are acting as automated momentum traders, and they are doing so at the absolute top of a valuation cycle.
Yeah.
You are no longer participating in price discovery. You are participating in a mechanical flow of capital that stretches valuations far beyond underlying corporate reality.
Feels like an analogy of a crowded theater where a fire breaks out.
Oh, yeah.
Everyone is blindly following the person in front of them, assuming that person has a map to the exit. But the person in front is just following the person in front of them, and the very first person in line is completely blindfolded. No one is actually looking at the architecture of the building.
It's worse than that because the architecture of the building is actively shifting while they're walking, and Wellum also highlights a secondary trap that catches investors who think they are being proactive. Closet index funds.
Oh, the mutual funds that charge you a 1% premium for active management. But when you actually read the prospectus, their top holdings are identical to the passive S&P 500 ETF that charges 0.03%.
Exactly the issue. The managers of these funds are terrified of underperforming their benchmark index and losing clients, so they just quietly mirror the largest holdings of the index. Wellum points out a crucial metric here, active share.
What's that?
Active share measures the percentage of a fund's portfolio that differs from its benchmark index. If a fund's active share is below 60%, you are essentially paying a premium fee for a closet index fund.
That's rough.
You are getting all the structural risk of the top-heavy passive bubble, plus the drag of active management fees.
So if I'm looking at my brokerage screen right now, and I see my meticulously researched, highly profitable value stocks flatlining for months, while a handful of tech megacaps are up 40%, this is the exact mathematical reason why.
Yep. The automated liquidity is bypassing the real economy and pooling at the very top of the index.
What is the tangible, actionable takeaway for the self-directed investor here? Like, what do you do with that information?
The takeaway is that active stock picking is an absolute necessity right now to avoid the eventual mean reversion of this top-heavy market.
Sure.
You have to look under the hood of your portfolio.
Yep.
If you use mutual funds, demand to know the active share. If it's not well above 60%, consider reallocating.
Right.
And if you are picking individual equities, you have to explicitly pivot away from the overvalued megacaps that the passive flows have artificially distorted. You need to hunt for companies with high free cash flow yields, low PE ratios, and robust physical operations that have been starved of capital by the automated index flows.
So the genuine value of the margin safety is hiding in the hundreds of solid companies that the algorithms aren't programmed to automatically buy.
Exactly.
Well, let's follow that logic, because if the equity market's passive index structure is this dangerously top-heavy and detached from reality, the traditional textbook response would be to take your chips off the table and hide in government bonds.
Right, the classic move.
That's the entire premise of the classic 60-40 portfolio, 60% growth, 40% safety. But the Finance Abridged brief outlines in agonizing detail that the safety portion of that equation is fundamentally broken. We are currently in the terminal phase of a 40-year bond bull market.
This is where the Great Restructuring stops being a theoretical exercise and becomes an immediate threat to conservative wealth preservation. We have an opinion piece cited in the brief from Fortune, co-authored by Steve Hank, an applied economist at Johns Hopkins, and David Walker.
And it's crucial to note that David Walker is a former U.S. Comptroller General. He literally ran the Government Accountability Office.
Yes, his credentials matter here.
Yeah.
And their assessment of the U.S. bond market is brutal. They warn that U.S. government fiscal policy is entirely imbalanced to the point of bankrupting the country.
I want to make sure we don't just gloss over the phrase bankrupting the country as political hyperbole, because they are talking about pure mathematics here. We are running massive, multi-trillion-dollar annual deficits during times of relative peace and employment.
It's unprecedented.
The interest payments on the national debt alone are crossing the trillion-dollar mark, literally exceeding the entire defense budget.
And that mathematical reality guarantees massive future inflation as the only viable escape valve.
Right.
A sovereign entity that issues its own currency rarely defaults in the traditional sense of missing a payment. Instead, it defaults by printing the currency required to pay the debt, thereby silently destroying the purchasing power of the currency itself.
And Doug Casey views this exact dynamic through the lens of what he calls crisis investing. He makes a fascinating point that international adversaries, the Russians, the Chinese, the Iranians, aren't blind to this fiscal math.
No, they see it clearly.
They are actively watching the U.S. empire face severe structural decline. They see the debt spiral just as clearly as Hank and Walker do, and they are restructuring their own global trade outside of the U.S. Treasury system.
Furthermore, we are seeing the immediate real-world consequences of this debt monetization hitting the consumer level globally. The brief cites Daryl Bricker's demographic and economic data looking right next door at Canada.
What's happening there?
30% of Canadians literally cannot pay their current bills. They are experiencing a brutal cost of living crisis alongside shrinking population metrics. This is the tangible result of a system where the middle class is steadily squeezed out of existence by the systemic inflation required to service massive sovereign debt.
Hold on, let's bring this directly back to the listener's portfolio. If traditional 60-40 portfolios rely entirely on government bonds to act as a shock absorber when equities get volatile, what happens to the average self-directed investor when bonds become the very instrument causing the damage?
If we connect this to the bigger picture, it requires completely rewiring your psychological definition of safety. For 40 uninterrupted years, from the early 1980s until very recently, long-term sovereign debt was the ultimate risk-free return. You bought a treasury bond, it yielded 5 or 6%, inflation was low, and you slept perfectly well at night knowing your capital was preserved and growing.
Yeah.
But because the structural debasement of the currency required to inflate away today's massive government debts, bonds are violently transitioning into return-free risk.
Stop right there. Let's repeat that phrase because it completely turns traditional finance on its head. Return-free risk.
It is a chilling phrase, but it is mathematically precise. Look at the actual mechanism of wealth destruction here. Let's say you buy a safe government bond yielding 4%.
Yeah.
But the real inflation rate, the actual cost of replacing your standard of living, your groceries, your energy, your healthcare is running at 7%.
Okay, so the math is upside down.
Nominally, you are making 4%. In terms of actual purchasing power, you are losing 3% of your wealth every single year. Guaranteed. You're losing wealth safely. Institutional money, the smart money, is recognizing this shift right now. They realize that you simply cannot out-yield structural currency debasement using fixed income instruments.
So for the retail investor, the takeaway is that you have to fundamentally reevaluate any assumed safety in long-duration bonds. They are no longer the sturdy counterweight to your equity risk. They are a distinct, standalone vulnerability explicitly tied to fiscal insolvency.
And that realization forces capital to seek an alternative anchor, which leads us directly to the massive volatility we've seen in the physical asset space.
Which is the entire editorial spine of this week's brief. If passive equities are fundamentally distorted by algorithms, and government bonds are entering a terminal decline due to inevitable debt monetization, the top takeaway from the aggregated analysts is crystal clear. You must increase your allocations to physical precious metals.
It's the logical conclusion.
It is the only historical hedge against this specific type of unavoidable currency debasement. And we have to talk about the absolute whiplash in the gold market over the last few months because it has tested the nerves of even the most convicted investors.
The volatility in precious metals has been staggering, and if you don't understand the mechanics behind it, it will shake you out of your position at exactly the wrong time.
Truly staggering. Let me lay out the specific data timeline from the brief so everyone has the context. Gold recently went on an absolute tear, defying all traditional headwinds, and hit a historic eye-watering peak of $5,434 an ounce.
Huge move.
And then almost immediately it suffered a brutal, violent correction. It crashed all the way down, finally finding a technical floor of $4,100 before rebounding and stabilizing at its current support levels near $4,725. If you were holding physical metal or heavily leveraged in mining stocks, your portfolio was swinging wildly by the day.
It is enough to induce panic selling if you view it through a traditional lens, but we have to analyze this specific volatility through the framework provided by Gary Wagner in the brief. He introduced a concept that is vital for modern investors, the compression of time.
Explain how that works mechanically. Are we just talking about shorter attention spans?
No, we are talking about the speed of systemic liquidity and algorithmic execution. Because of the instant flow of global information and the dominance of algorithmic momentum trading, market cycles in precious metals are speeding up exponentially.
Wow.
Look back at the gold bull market of the 2000s. What used to take 4 or 5 years to play out, a steady bull run, a speculative peak, a severe correction, and a long consolidation phase is now mechanically compressed into a matter of months.
That's wild.
Wagner notes that to successfully navigate this, you have to look deeply into market psychology, sentiment, and structural positioning, and actively push away the traditional variables that used to govern gold pricing on a daily basis, like ignore minor fluctuations in the US dollar index or a 10 basis point move in the treasury yield.
So the traditional inverse correlation dollar goes up, gold goes down is breaking down because the structural fear of currency debasement is overriding the daily currency crosses. And Steve Hankett comes back into the picture here regarding that structural fear. He argues that Wall Street is just completely fundamentally wrong in their models, predicting that inflation will smoothly return to the 2% target.
He is not mincing words.
No. Based on the money supply metrics he tracks, he sets a firm, calculated target for gold heading to $7,000 an ounce.
And while Hankett provides the macro target, the VRIC media perspective highlighted in the brief provides the vital mechanical context for the retail investor's psychology.
Which is so important right now.
VRIC explicitly predicted this exact violent behavior we just witnessed. They stated beforehand that a severe 25% correction, which is precisely the math of dropping from $5,400 to $4,100, is not a sign of a failing asset, but a totally normal mechanical necessity.
Let's walk the listener step by step through the actual mechanism of that 25% drop, because I think a lot of people just assume more people wanted to sell than buy. But it's about leverage, isn't it?
Entirely about leverage. When an asset like gold rockets up past $5,000 that fast, the speculators driving the final leg of the rally aren't using all cash. They are using massive leverage provided by their brokers.
Right.
They might put down $10,000 to control $100,000 worth of paper gold contracts. When the price inevitably dips, even slightly perhaps due to profit taking, the total value of their position drops. Their broker issues a margin call, demanding they put up more cash immediately to cover the loss.
And if they don't have the cash,
the broker automatically liquidates their position.
And when thousands of those automated liquidations trigger at the exact same time, it creates a cascading waterfall of sell orders.
Exactly. It forces the price down further, triggering the next level of margin calls, wiping out the next tier of leverage players. It physically flushes the speculative leverage out of the system.
Wow.
The market has to execute this violent flush to reset the technical baseline before it can fundamentally build enough strength for its next leg up. It is a necessary clearing mechanism. And VRIC's ultimate target for that next unleveraged leg up is $12,000.
Jeff Whittaker also weighed in on this, providing a sharp critique of how mainstream finance continues to mismanage this asset. He points out that despite all this macro data, most traditional portfolios and standard financial advisors are still completely wrong on gold.
Yeah, they treat it as an afterthought.
They continue to treat it as this weird fringe asset, maybe throwing a 1 or 2% allocation at an ETF just to say they have exposure. Wagner argues forcefully that the mindset has to shift. Gold must be viewed as a mandatory core allocation, specifically needed to offset the fundamental failure of sovereign bonds we dissected earlier.
That's a huge shift in perspective.
So bring this back to the individual listener who, let's be honest with ourselves, probably felt the FOMO. Bought a heavy position in a gold ETF near the absolute top at $5,300, watched in horror as it puked down to $4,100, and is now sitting at their kitchen table sweating bullets at the current price of $4,725. What is the psychological framing they need right now?
The framing is recognizing the difference between a broken macroeconomic thesis and a technical flash.
Okay.
The violent drop to $4,100 did not alter a single underlying fundamental. The massive sovereign debt is still there. The structural inflation is still there. The geopolitical decoupling is still there.
Nothing has changed fundamentally.
Nothing. The action item for the self-directed investor for the next 30 days is to use this current stabilization period around $4,725 as an accumulation zone. Use these quiet, boring periods of consolidation to build your physical metals hedge. You do not chase the manic peaks when leverage is high.
Okay, so physical gold serves as the structural long-term bedrock hedge against the currency debasement. It's the foundational insurance policy for the Great Restructuring. But no one's portfolio is entirely defense.
True.
We still have to manage the speculative, tactical, growth-oriented side of the portfolio in the short term. And this is where we need to draw a very hard, explicit line regarding digital assets because the media constantly conflates them.
This is a strict, non-negotiable guardrail for our analysis today based on the sources. We must explicitly separate the gold and silver thesis from the crypto thesis.
They are not the same thing.
They serve entirely different mechanical functions in a portfolio, even though financial media anchors lazily lump them together under the umbrella of alternative assets. Gold, as we've established, is physical, historical insurance against structural monetary debasement. Crypto, specifically as analyzed in our brief by Joe Bland, must be viewed entirely through the lens of high beta speculative trading behavior.
So when Joe Bland is analyzing crypto plays, and the brief specifically mentions assets like DPRO Dragonfly, he isn't talking about storing wealth for a decade to survive a sovereign debt crisis. He's looking at the math of momentum.
Completely. Bland approaches these assets entirely through technical charting, momentum indicators, and tools like Fibonacci retracements.
Let's demystify that term really quickly for the listener, because Fibonacci retracements sounds like financial wizardry, but it's really just a mechanical reflection of math psychology, right?
It is a self-fulfilling psychological boundary. A Fibonacci retracement is a mathematical sequence that algorithmic traders and thousands of speculators use to predict where a falling asset price will find support and bounce back.
Oh, I see.
For instance, a common level is a 61.8% retracement from its previous high. Because thousands of trading bots and technical analysts are all looking at that exact same mathematical line on a chart, they all place their automated buy orders at that exact price point.
That makes sense.
When the asset hits that line, the massive influx of predetermined buy orders forces the price to bounce. It works because mass behavior forces it to work, entirely divorced from whatever utility or fundamental value the underlying crypto token actually has.
Which reinforces the danger of conflating the two. Do not buy a highly volatile, technically driven digital momentum asset under the mistaken belief that it's going to act as a stable 5,000-year-old physical wealth preserver during a macro crisis.
Right, that's a recipe for disaster.
One is an insurance policy, the other is a calculated high-risk speculation driven by narrative and technical structure. Both can exist in a portfolio, but you must know which one you are holding.
Exactly.
Speaking of tactical timing, let's talk about the broader equity markets, because Lance Roberts and Mark Newton have a very specific, united warning for investors looking at their screens this week. Don't chase this rally.
Newton is looking deep into the internal plumbing of the stock market right now. He's not looking at the headlines, he's analyzing market breadth, meaning how many individual stocks are actually participating in the upward move versus just a few megacaps dragging the index up.
Right.
He's looking at momentum indicators and retail sentiment. Based on the deterioration of that internal data, he is predicting a distinct technical market pullback arriving by May. The momentum is mechanically exhausting itself.
But there is a crucial second half to their analysis. They aren't predicting a systemic crash. They strongly advise that following this May pullback, the market will likely catch its breath, reset its technical indicators, and race to new highs heading into the summer.
Which introduces the single biggest psychological trap for the retail investor, and Lance Roberts provides a steadfast rule to combat it. He states flatly, you should never go to 100% cash.
I want to highlight this because it goes against every basic human survival instinct. When an investor hears an expert predict a May pullback, the immediate emotional response is to sell everything, retreat to the perceived absolute safety of cash, and wait for the dust to settle. Why is that mathematically the wrong move?
Because the mechanics of timing the exact bottom are functionally impossible. If you panic and liquidate your entire portfolio to 100% cash, you might feel safe during the initial drop. But when the snapback rally that Newton is projecting for the summer eventually triggers, it will happen violently and without warning, usually driven by algorithmic buying.
Right.
If you are sitting entirely in cash, human psychology dictates you will hesitate to buy back in, waiting for a confirmation that the rally is real. By the time you feel safe enough to re-enter the market, prices will have already surged past where you originally sold.
Wow.
You end up buying back in at higher prices, permanently destroying a massive chunk of your capital.
You essentially lock in your losses and miss the recovery. Add to this complex timing environment the underlying political dynamics we are seeing right now. The brief features analysis from Heresy Financial, pointing out some deeply alarming trends under the surface.
Oh yeah, this is wild.
They warn that blatant insider trading by politicians in Washington is getting completely out of hand, creating an incredibly uneven playing field where legislative insiders are front-running major policy shifts.
It's a huge issue.
Furthermore, they note that the bond and equity markets are showing early internal signs of rejecting potential Fed chair Kevin Warsh. The institutional money is getting jittery about future leadership. There is a lot of nervous, unstable energy coiled under the surface of these markets.
Absolutely.
So let's synthesize all of this into a concrete plan. The listener has absorbed the macro shift, the index trap, the bond failure, and the gold volatility. So what does this all mean for the cash sitting in a brokerage account right now? What is the actual step-by-step playbook based on this week's data?
Here is the clear 30-day tactical plan based on the synthesis of these 35 experts. First, prepare yourself emotionally and financially for a technical equity pullback in May. Expect to see red on your screen and understand that it is a mechanical exhaustion, not the end of the world.
Okay.
Second, strictly obey Lance Roberts' rule. Do not panic sell your entire portfolio to 100% cash. Instead, use the May dip as an opportunity to strategically deploy the cash reserves you currently have.
Deploy them where?
You want to hunt for those active share equities we discussed with Jonathan Wellham, the high free cash flow, robust, physical businesses that have been temporarily starved of capital by the blind index funds. If it fits within your personal risk tolerance, you can allocate a small percentage to the speculative crypto charts Joe Bland outlined, purely as momentum plays. And fundamentally, let your structural physical gold hedge ride through the current volatility. Use the current stabilization levels near $4,725 to accumulate more ounces, resting securely in the knowledge that the underlying macro thesis, the Great Restructuring, and inevitable currency debasement remains entirely intact heading into the summer.
That is an incredibly clear and actionable blueprint for navigating a very chaotic transition. As always, this is analysis, not advice. Talk to a qualified professional before making changes to your portfolio.
I want to leave you with a final thought that weaves a few of these massive threads together into a rather profound question.
Let's hear it.
We've established that passive algorithms have fundamentally broken the price discovery mechanism in the stock market, per Jonathan Wellham. We've established that central banks and massive deficit spending have fundamentally broken the assumed safety of the bond market, per Steve Hanke and Michael Howell.
Right.
If traditional equities are distorted and traditional bonds are returning guaranteed losses, will the ultimate outcome of the Great Restructuring force serious investors out of the legacy financial system entirely?
Oh, wow.
Peter Diamandis, cited in the broader sources, hinted at radical exponential future shifts on the horizon, things like extreme human longevity breakthroughs and functional brain-computer interfaces.
Yeah.
It forces you to wonder, will the serious self-directed investor of the 2030s be focused on hedging against standard monetary inflation, or will they be forced to build portfolios that hedge against human obsolescence itself?
That's intense.
Something truly foundational to mull over as you review your allocations this weekend.